Let's talk about the risk for Europe, because on stage at IAF last week, I asked the chair of a major French bank if sovereign ratings, bond vigilantes would catch up with Europe down the track on the back of these big fiscal endeavours. And he said no. I was like, well, why not? And the view was like, no. And I said, well, look, it does actually matter how bond markets perceive your spending packages, whether they're funded, whether they're responsible. And we see it even in the United States at different times. The market has tested the US Treasury. We've seen it here in the UK, seen a safe debt as well. The bond vigilantes have circled. Why can the bond vigilantes not take another look at Europe for some of the countries that are not in a position like Germany and they spend up more on defence down the track?
I think the issue is how you spend the money that you raise issuing sovereign and corporate bond. If it is, spent in a productive way, efficient way, something that increases, growth. You mentioned the report before, the European reports, Ursula von der Leyen. If it's something that increases efficiency, so in a sense the return of investment is greater than the cost of issuing, then in a sense it's not a problem,
Okay, well, let's go to defence then. Is defence a good return on your money if you're sitting in some of these European countries with no money?
The market response to the announcement of Germany was quite interesting.
Not Germany, the other countries.
Yes, the others. This is can be a quality investment that can also lead to growth, maybe more efficient than others. So I think we have to see. And again, you haven't seen a difference in the spreads across countries. You saw this spike for Germany, but then the rest was the same. Euro appreciated. Again, the market in Germany, also the others, their reaction was quite non-negative. Even rating agencies were non-negative on that. Actually, it should even increase. So I'm not, I would say, super worried. Again, it's important to check how you spend, also on the corporate side.
But can they even spend? I mean, the other big point of this discussion is that Europe is saying, look, spend 1 to 1.5% of GDP on defence. Some of these countries don't even have the ability, do they, to get to the 1 to 1.5%?
First of all, these are, let's say, options. So you can do it. You're not necessarily, obliged to do it. We will see also the discussion on what will be. But markets are, I think, deep and liquid. Liquidity is still there. So I think there will be the possibility of issuing and then also people buying. The issue is that who is buying, the quality of the buyers is an issue. Now, more and more sovereign debt is not, due to monetary policy tightening, bought by central banks. We showed also in the report that basically central banks, the net holding decreased of 10%. And this 10% is exactly the increase of households and foreign investors. These are more price-sensitive investors, sensitive to,
That's
trade.
That's a brilliant point. We often talk about the quality of the debt, and as you quite rightly said, what the debt is being used on, but the quality of the buyer isn't something we necessarily spend as much time talking about as well. So what I think you're saying there as well is actually it's a more volatile situation because the central banks have pulled back from buying as much debt as they previously did.
Absolutely. Other things being equal, households or foreign investors buying foreign debt, they are more, interested in, volatility, prices, while a central bank typically for monetary policy held to maturity.
Does a trade war actually increase that sensitivity? I would suggest yes, but I want your evidence as well. And also, does it mean that actually not only is the quality of buyer less, but actually there are less buyers, full stop, if we have protectionist barriers picking up?
I think yes, and yes, why? Especially for some countries, and again, in emerging countries, we have 10 trillion, 12 trillion actually stock, three of issuance. These investors and foreign investors are there, but you need international, financial flows working smoothly and efficiently. With, geopolitical tensions, including, trade wars, these can have an impact in who is buying and also actually in the ability to tap the market at all.